Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to host the first and exclusive Capital Markets Summit to coincide with the October 1987 stock market crash. And over the next, so it was painful to us all, I'm sure. And over the next 30 minutes, I'm planning to discuss the economy, equities, and everything investment related with four of the smartest minds in the city, namely Justin Urquhart Stewart, founder of 7 Investment Management and Regionally, David Buik, consultant at AQUIS Exchange, Chris Watling, founder and CEO of Longview Economics, and Martin Gilbert, who you probably all know as well, is the CEO or ex-CEO of Aberdeen Asset Management and a founder of that group. So welcome, gents.
Welcome.
Hi there.
Hello.
Pleasure to be with you.
Good. Right then, Justin, can we kick off with you? When we last chatted, you were reasonably positive, and what we've seen, certainly, even when there's sort of terrifying dips of Black Monday back in October 1987, that was a good strategy to buy when there was maximum fear. And likewise, we had that this year when it fell to in March and April. We've now seen the markets recover and rebound, but sort of got into a bit of a limbo land over the last couple of months. Where do you see the markets heading? And are you playing offense or defense?
Well, it's a world away from 87. I mean, that was a completely different, not just period, but different reasons why all that occurred. And after all, remember, within a year, that had vanished. There was no crash year on year. You don't see it. This is very different this time. You know, we're seeing a fundamental change in the way our economy is actually going to be operating. And the one thing you always find out in the markets is, you know, it's time in the market rather than timing it. Timing it's bloody difficult to try and do. What we are going to be seeing, and we're going to be seeing a lot more volatility, so the opportunity of being able to use that volatility for our own benefits to be able to pick up good quality assets, even though the economies themselves have changed, and we're going to have to take account of that. So businesses that were seen to be good, straightforward, blue chip stuff you want to be involved in, now the attitude is changing. What's of the pandemic, but all the issues relating to environmental elements have made that I'm sure those companies are changing. But nonetheless, staying out of this, I think, is going to be a mistake. Keeping cash aside to make sure you can take advantage of those things, I think, is always going to be a good thing. I've always managed to lose money by actually being out of the market. I don't make money by being in it, but to actually use that volatility to our own benefit.
So you kept some cash on the sidelines for buying opportunities, and would it be correct in thinking you're sort of like, again, medium to long-term optimistic? Is that a correct sort of like view? Is that where you stand? Yeah.
Well, if I was going to be medium to long-term pessimistic, I would just send down to my wine cellar and stay there. In which case, I won't really care about which stocks I've got. Look, the global economy ain't going to be stopping. It's still going to be carrying on. It's been seriously injured. But we can see from next year's figures, there's still going to be growth. China's going to be growing. America's going to be growing. I know we've got the election, all that rhubarb to go through. So, you know, we have been damaged. It's going to hurt growth. But fundamentally, there's still going to be some growing companies. And over the next few years, because of what has happened, it's going to throw up some fantastic opportunities, not actually always that far from home either, of businesses which are restructuring themselves, throwing off assets, some because the private equity companies have been done too many deal junkies on them and found themselves actually, well, they're probably going to go bust anyway. Remember, we were heading for a very significant slowdown before this all occurred, but also companies breaking themselves up and the increased localization, into seeing increased local demand for businesses to set up locally to provide local services and reduce those supply chains. So I think there's some great opportunities. It's just they're going to be different from before.
Okay, we'll come on to those a bit later. David, when we chatted 3 months ago, you were a bit more bearish, and that's actually proved the correct call because some of my portfolio has certainly gone down on value stocks. Where do you where do you stand at the moment in terms of the equity markets?
Yeah, but I was bearish for all the wrong reasons. I mean, the fact is I never saw those gigantic technological companies putting on the kind of gains that they've done. I mean, if you just look at what's happened to date, in the first, say, 10 months of the year, I mean, you've got the FTSE is the worst performer, down 23%. You've got the Dow is just 1% below the Plimsoll line. NASDAQ up 29% since the beginning of the year. And you can see the recovery in China because that's up 8% so far. So they're on their way, better than we are. And Japan is pretty flat. And I'm going to defer to Martin over that because I think the Far East is where he obviously brings much more than I ever will do. I think the situation I'm worried about basically is that Europe has been running around, as does the United States, like headless chickens and trying to get on top of this COVID-19. Nobody would have got it right. But I think it's just a horrible situation. And whereas everybody was promising a V-shaped recovery, I think that's ending up more like a U. And therefore, we've all known, Justin's alluded to it, and I'm going to take you back to the days of Margaret Thatcher in 79, 80, 81, when we had 3 million unemployed, but we still had quite a buoyant stock market. We had still quite a lot of IPOs coming to the market. It was a good place to be at the time. And I fear in the United Kingdom, we may well have 3 million unemployed by the end of the year. But that doesn't mean you jack it in. What you have to do is to be on the right horses and make sure that you're not backing 16-1 outsiders. And you've got to know where your growth is going to be. I don't think you can say goodbye to technology. I mean, when I looked at Zoom yesterday, which came out with that extra app, 648% rally since the beginning of the year. Nobody would have believed that. I think
we're using Zoom at the moment, so I think we're probably a case in point.
I think I'm very worried about energy stocks because I don't think oil really know where it stands in the world, and the likes of BP and Shell. I can spend quite a lot of time talking about that.
Before we go into the oil stocks, let's just touch on to with Chris with regard to the economy, because that seems to be unlocking most of where the direction of the sort of the equities will be heading. What's your latest view, Chris, in terms of? I know when we chatted 3 to 4 months ago, we were talking about Nike swooshes and K's and other letters of the alphabet. Which one are you? Are you going with the V or the U or L, or where are we standing at the moment?
Yeah, I mean, it's a great question. I think we're up for a sort of accentuated V. To be honest, I think there's a potential for an economic boom next year and beyond. And all we need is the vaccine. And we kind of forget the amount of stimulus in the pipeline is absolutely enormous. My favourite sort of stat du jour is British householders, for example, by the end of the year, will have in their bank accounts about £170 billion more than they would have had if we hadn't had a pandemic, which is 7.5% of GDP. So, it is sitting there. People can't spend where they want to. I mean, there is high unemployment, of course, to David's point, and it will go higher. Although I think most of the labour market adjustment, I think the majority of it is actually done. So if we get a vaccine, I think it's like throwing a match onto kerosene on a fire. Will just really be impressive to the upside in terms of economic growth. And for me, that supports the market quite nicely from here.
Well, you're certainly talking my language there, actually, Chris. And I think you're sort of like...
Well, it's good to have some good news. Good news.
I do hope you're right. What about you, Martin? And where do you see? So I know when we chatted, you were a bit in the sort of the Justin's camp. You saw opportunities, but you were being very selective in what you were looking at. And I know you liked Asia. First of all, just before you get on to that one, though, would you be a buyer of these sort of like high growth NASDAQ stocks that have really gone to the moon? Or are you sort of like still remaining very cautious at these levels, even though everybody else seems to be getting to the same side of the boat?
Yeah, I wouldn't be a buyer because if you think about the last time this happened, and especially in the FTSE in 99, 2000 with the Vodafones of this world and so on, I think these 4 or 5 stocks are a multiple in terms of percentage of the stock market that even that was. So yeah, I mean, and I could be wrong, but. No, I wouldn't be a buyer. I agree with everything. I'm positive on equities. I mean, it's the only place to have your money really, because a lot of investors can't get access to private markets, which is where the big boom is happening at the moment with this massive asset allocation shift happening globally from public markets to the private markets. I can't remember if it was Justin or David talked about China, but China's booming. I can see that from being on the board of Glencore, just seeing the amount of coal they're importing. And the economy there is fully recovered. Travel has fully recovered. So I agree with Chris to a certain as well, that once we start recovering, and I think listening to all the experts, we will have a vaccine by the first quarter of next year. So I think next year could be a great year because the pent up demand and as Chris said, that figure which I hadn't heard before is startling, which means sectors like home improvements are going to be fantastic stocks to buy. So yeah, I'm with the rest of them. We're all bullish.
I think David is still perhaps a bit cautious, and he's made the right call at the moment.
Yeah, we've all been. I mean, I think he's right. It rose too quickly, and then it's fallen back a bit. But it's a great lead indicator of the market. But I can't remember if it was. I think Justin spoke about 87. I still think 87 was frightening. I mean, the most frightening experience. I mean, the percentage falls were just massive. I mean, when you look back, Wall Street fell 25% one night. I mean, you just can't you just can't countenance those sort of falls since 87.
Yeah. And so, Chris, we're obviously a bit more sort of like we're biased to the upside. What about the actual market and the fear and greed? What are you seeing in your, when you advise, obviously, the institutional and hedge fund investors? Because it just seems we've got this, the old economy stocks, which have been being hit by the COVID, have just been battered. I mean, you just like name it, and just perm any sort of one from nine. The energy stocks, the banks, the travel, the airlines, the cruise ships. But then you've got the technology and the stay-at-home. We've just gone to the moon. Where does the market land? Is it making that distinction in terms of greed and fear, or is it in sentiment and positioning? I mean, what's the rest of the investors community doing?
Well, it's a great question. But the point is, when you print this much money, it's got to go somewhere. And as Martin alluded to, if you're an individual investor, there's really nowhere else to put it, is there? You don't buy bonds. Corporate bonds don't yield that much. So the money's got to go somewhere, and it's not going into the sort of half or 60% of the market, which is obviously deeply distressed at the moment. So I think the market's fascinating because it's to use the footballing analogy, it's a sort of game of two halves, isn't it? One market's in a roaring bull market, the growth stocks and everything related to that, and the other half is in deep bear market. So I think it's confusing trying to read greed and fear here. I'd say the market as a whole was exceptionally greedy coming into early September. You saw the tech stocks, all these sort of options outstanding, and the Robinhood. And in fact, Robinhood is a global phenomenon, by the way. It's in Sweden, it's in Australia, it's in Germany. It's across the world that the retail punters are at work. But equally, at the same time, we've seen lots of stocks in deep bear markets. But the market was greedy 2nd of September. Everyone blamed the fall on the US election, pricing in the risk of a contested election. But the reality was we were just pricing out frothiness. And the wonderful news is, on a short-term basis, by September the 23rd, 24th, it was pretty clear the market become fearful again. So on a week-by-week basis, it's doing what it's always doing. The market's actually quite orderly, with a sort of slightly higher volatility than normal. But I think it's behaving rather well. But to be honest, where are we now? We're bang in the middle of our short-term fear and greed indicators. So I think there's potential, once we get through the election, maybe a bit of short-term volatility for more upside in the near term as well as when we go into next year. So positioning is very mixed, I would say, and greed's quite mixed.
Justin.
Yeah, Paul, this is a classic position we've got now, where the markets we've been used to for so long, frankly, have been used, they've got tired, and where's the next stage? Certainly London's at its best when it's trying to reinvent itself and do new things. We've got a lot of stale stuff at the moment. And certainly when you look at the AIM market, it's nowhere near what it should be. It's certainly not the beast that was created in Glasgow 35 years ago. So now actually what you've got is what David's doing at AQUIS, and certainly what we're doing at Regionally, bringing in new areas for people to be investing in, where you're actually going to find new growth areas. The problem is, at the moment, you've been looking at a market which has actually been effectively, in terms of the number of stocks, we've seen some pretty unimpressive companies coming through. And the next stage of developmental companies, technology companies, are going to be at the smaller scale, and ones which haven't been able to get to the market before because they've been taken over by private equity. I'm not suggesting you invest in private equity. There are new areas to be able to try and get into, and that's going to be changing over the next few years. That's going to be very exciting. It's going to be higher risk, but it's going to provide greater alternatives to people.
And you mean things
Justin, maybe we should stop speaking about market and speak about stocks, because it's focusing on a market is the wrong thing to do, because the reason Nasdaq's up is because certain tech stocks are up. The reason FTSE's down 23% is because we tended to be dominated by, I don't want to use the word old economy, but stocks that have not done particularly well. So it's just really a reflection of the underlying shares. And I think there's huge opportunity if we choose the right shares.
What about
but the point of actually introducing new shares coming through, new areas for people to be investing in, and I think that's going to be the interesting point.
I agree.
Go on, David.
Paul, can I just interject for a second?
Do.
One of the things I'd quite like to raise with Martin as well is that, apart from the fact, let me just preempt by saying that what Justin said about the medium-sized new companies all wanting new capital, there are going to be extremely exciting adventures in the UK. My advice would be that don't pay too much attention to the FTSE 100. It is not a barometer of the UK economy by any stretch of the imagination. I'm very sweet on Japan, and let me just tell you why. We started off with the World Cup, then we had the Olympic Games were going to happen, and because, as Martin will tell you with much more detail, the regulation of and lack of incestuous behaviour in Japan has largely been ironed out. And I think, it's taken them whatever it is since '87 to recover when the Nikkei was at 39,000. But I think Japan, with a bit of luck and a following wind, if you had to select one continent to make some real growth in the course of the next year, I would choose that. I would choose it ahead of Shanghai because I don't know enough about it and I don't know how easy it is to invest in that. Martin, can you help us there?
Yeah, no, definitely. Japan has definitely changed for the better. The only other area of Asia I would probably see value is in ASEAN, the Singapore, Malaysia, Thailand. India does brilliant companies, very good governance, but they're very expensive. I can't remember, my old chairman said, in China, you want to be as close to the government as possible. In India, you want to be as far away from the government as possible. and I think it's a great way. So India is great. China's difficult to make money, but there are great companies.
How do you actually invest in Martin? How do you invest in those areas? If you're a retail investor or a professional,
you can only do it through
stocks is tough.
Reflection of the whole region.
You can only do it through funds, basically, and you just follow the good fund managers. As you know, I've worked with Hugh Young for 32 years, and hopefully he's made most mistakes it's possible to make. But fund managers get better as they get older, so it's unlike any other sport.
It didn't happen to Anthony Bolton.
I did, yeah. Well, I think he was too trusting in China. And he went in, and he didn't really see. He was, and maybe he shouldn't have done it. Anthony's one of the nicest guys you'll ever meet, as you know. But maybe he should have stuck to what he was really good at.
That was very sad. He was sold a pup with that one. He was really good at doing what he did, and someone I think probably sort of said, "Yo, go on, you can walk on water."
9 years out of 10, he was
great shape.
Emerging areas is look at Mark Mobius. There again, that expertise has played out time and time again.
Oh, no, he's good. And same with Woodford. Everyone sort of criticizes him, but Woodford was really good at what he did, and it was really when he got caught with a liquidity trap. But if he'd stuck to what he was really good at, which was income investing, he was world class.
But Martin, wouldn't you accuse? For instance, the one person, not the one, but a person who stands out as having done brilliantly in the last 3 years is Terry Smith with Smith.
Oh, yes.
And he's only got, I think, about 37 stocks that he actually looks at. And the thing about Woodford, I met him a couple of times. I don't know him, but I've met him, and I was hugely impressed. What I didn't understand when he set up his own business, when he left Martin Albeeb and all that, is why he had to get a bit spivvy. It wasn't necessary.
Yeah, I think he believed in healthcare was going to, and he's probably right long term, but it's been a harsh lesson for him to learn that open-ended funds are not the correct structure for unquoted unquoted investments. But Terry's world class. I mean, I think he's an amazing fund manager. He never trades. He just buys and holds. He's amazing.
Well, just on that subject of sort of buying and holding, I mean, it sounds as though we're obviously reasonably biased to the upside and looking for a good bounce next year. So sectors perhaps to have a look at. I mean, clearly, if there's any which is in the new sort of like post-COVID world that is cheap, then that would be perfect. And also sort of like those stocks which will rebound quickly. Now, I'm only going to throw one out, and just because everybody's got a view, and I polled this from the sort of the Vox investors, is GSK. It's trading at half the valuation of Astra, i.e. on an EBITDA basis, and it's the world's best vaccine maker, or got the most amount of experts, and is got a huge franchise in respiratory diseases. What am I missing? Is anybody sort of like anybody had a view on GSK, David?
Yeah, very quickly. I mean, I can't argue with a single word you said. The only thing I would say is this, is that Emma Walmsley, who I think is a quality individual, but, you know, she's been a bit like Boris Johnson. She doesn't know whether she wants to be in healthcare or out of it. She's selling this to Novartis, buying this back. No, we're not going to do this in vaccines, and no, we're not going to do this in oncology, and yes, we are. You have to have a path, I think, where everybody is agreed on what the policy is. And I think she's been, how can I put it to you, a little erratic, and that, I think, has affected the share price.
Okay, well, we'll move on from GSK. But Chris, now, you mentioned about a strong rebound. What is going to happen to the oil price and oil stocks? I mean, I cannot believe it. But I looked today, and BP is trading at below it was in April when the oil price of the futures front contract went to minus $30 per barrel. I mean, it just seems absolutely just nonsensical that the oil stocks, are these guys ever going to get a bid, or is it really just the sort of the ESG angle which is killing this whole area?
Well, I think ESG is definitely part of it, but of course, you know, back to the Woodford discussion. I mean, BP and Shell were big income pairs, weren't they? Big dividend pairs, and so there's some challenges from that as well. I mean, no, I think interestingly, the oil price itself, which they tend to follow it eventually, should be well bid. I think oil is quite interesting here. It's pretty cheap, around this sort of 40 and change level, and actually there's been very good supply discipline from OPEC, and there's been very good, you know, shale. You know, I think the stat is 60% of shale oil is from a well that's been drilled in the last 12 months. And of course, there's a lot of bankruptcies in shale in the last 6 months. There's a lot less oil being drilled. So from the supply side, you're getting the discipline and the lack of growth. And then from the demand side, if we're right about this economic boom, and by the way, it's not just the UK that's cashed up. We reckon $2 trillion extra in US bank accounts than there otherwise would have been, which is 10% of US GDP. So we're in a world of helicopter money that's going to be spent. So I think the oil price has got plenty of upside from here, and I wouldn't be surprised if it made it to $60 next year.
Wow. And David, another sort of highly controversial sector. I know you're an astute follower of the banking sector. Well, we had blockbuster results from Goldman's, Morgan Stanley, and I think I can't remember the other big sort of like City Money, JP Morgan.
Oh, JP Morgan.
Yeah.
Well, I mean, they were outstanding, but you've got to put this in context. Is that if you look at the British banks, the top five, they've all lost 50% in value since the beginning of the year. Why? The number of reasons is, one, there is no dividend payable, which is obviously has affected the share price. Two, there's absolutely no variety in their business whatsoever since the banking crisis of 8-9, when George Osborne said, you've got to get out of investment banking. And Barclays said, please, sir. And they said, well, if you want to do it, go to New York and do it from there. So when you think there doesn't seem to me, and it's only me, any imagination whatsoever from any of the British banks to go and buy, say, Martin Gilbert's business or something, fund management, wealth management like UBS or Credit Suisse, you're never, ever, when you've got an interest rate structure like this, which is going to be somewhere near zero for what, 3 years probably? And the fact is that you're going to have had enormous provisions for bad debt. The banking sector is not one that I would get involved in unless I felt that I could put it in the bottom drawer and wake up in 5 years' time and it's really done me proud. But you take all the records of Goldman's, Morgan Stanley, JP Morgan, Citigroup, Bank of America, what do they deliver? Trading. And they said absolutely nothing about their banking apart from trading. And that's why we've had a pretty good fillip. But just in case you think that I'm on the thing, US banks against the benchmark of the S&P 500 and the Dow have also performed very poorly. Listen to this. Goldman Sachs, since the beginning of the year, down 10%. JP Morgan, 40%. Bank of America, 34%. Citibank, 47%. And the daddy of them all, Wells Fargo, no investment banking or anything else, 75% down since the beginning of the year.
It's all bond yields, isn't it? It's a bond yield story. Sorry.
Yeah, just.
So I was just going to say it's a bond yield story. Go on, Justin. Apologies.
No, that's all right. Well, Dave's right. You separate out different types of banking. Commercial banking with these interest rates, there's going to be nothing there, no money to be made. What's fascinating is look at the amount of transactions going ahead in terms of M&A and the IPOs that are coming through, some fantastic fee streams coming through. Then, as we saw with the purchase of Vance the other week as well, now see the American firms moving towards the wealth management companies, buying up those assets. Whether they'll run them very well or not is a different issue. I think they'll probably run them, as normally, rather badly. But it doesn't matter. That's what they'll be bidding for, to actually try and get more of those assets underneath. So actually, I think these are wonderfully undervalued, but they are not all the same. Separate the commercial banks from those that are actually doing that are going to be doing the M&A and the IPOs and moving towards that wealth side.
One thing I think.
Sorry, if I could just add, I actually think it could be a really good sector to be in next year, because if you look at the banks, they generally follow where the yield curve goes. So if we're right about this economic boom idea, 10-year yields are going to be backing up. And some of them in Europe are exceptionally cheap, trading at half times book or less than that. Yes, they haven't got the investment banking business, sure, but commercial banking business will do that. Those stocks will do well if we get the switch into value next year and this back up in the yield curve. And that's the key, really, frankly. I agree with the split between IB and commercial, but that's the key for the banks in general.
The other thing is, which I think is really tough over here, is the cost of capital and the regulatory controls of the banks is draconian, Chris. And that's what really worries me. Everything you've said, I 100% agree with you, given a level playing field. But this compliance and this regulatory controls is absolutely burgeoning.
I agree. Well, hopefully post-Brexit, we'll be able to get away from that.
Yeah,
Chris, I saw a very interesting statistic, which was the government's interest cost as a percentage of GDP. It's at a record low. So everyone who worries about government debt is going down the wrong angle. The government can afford to borrow as much as they want because it's so small a percentage of GDP. I think I saw it was like about 1 or 2%, down from about 7 or 8%. So that's something that no one has really picked up. Is this government can borrow? It's a great
point, Mark. Sorry, I would just add to that, Martin. It's a great point. If you look at the household debt service ratio in the States, I happen to know the number, it's at a 50-year low. So it's the same idea.
Yeah. So people can afford debt at the moment. I was going to say, just going back to David's point, the banks, HSBC needs to split. It can't run a British retail bank and a Hong Kong bank under the same listing.
And would that release value, Martin?
Oh, huge value. Yeah, huge.
And I must admit, if you turn the clock back to where the great financial crisis was, which sector moonshotted when we started seeing house prices rise back in 2010, 2011 in London? The banks went with threefold in about 3 nanoseconds. So I'm with you, Chris. If we do see this bullish view, these things are priced to destruction. And I think if loan loss reserves stay stable, and what's quite interesting, it hasn't been picked up by the media, is that regardless of the yield curve, the effective borrowing and lending costs of these institutions is much steeper, because there's only one bank that companies can go to, and therefore they having to get charged, higher levels than they would do previously, and they can borrow at low levels as well. So you do see that decoupling. But anyway, moving on from a controversial bank sector, Martin, your expertise in terms of everything sort of investment orientated, and likewise with the finance, where would you pitch sort of good investments in the financials if you want to sort of like play a rebound next year? Would it be the asset managers? Would it be the insurers, for instance? Because they're like Aviva. I mean, that's again priced to absolute death.
Yeah, they're all cheap. Yeah, I would definitely look at asset managers, just because I think there's going to be a massive consolidation, and we saw that last week with the second biggest deal in the sector ever, with Morgan Stanley doing what it should do, by the way, which is diversifying earnings to better quality earnings by buying Eaton Vance. So that was a very astute move, I thought, by James Gorman at Morgan Stanley. The insurance companies look good value. We discussed the banks, but I also like sectors. I mentioned it earlier. I like sectors where the investor can spend their money now. So, and I think a lot of them are going to spend money upgrading their homes. However you could play that market, the Howdens of this world, or these sort of companies. So I like these sort of sectors. I'd leave the airlines alone just at the moment. I think it's going to be a long, slow recovery there for the airlines, Paul. Yeah,
to that point, actually, there was interesting trading from AO World yesterday, and their sales have increased by 57% because everybody's buying bread-making machines, coffee makers, and chest freezers. And they're just moonshotted out, so their shares will.
If you're stuck at home and you're not spending any money or doing anything else, now you're actually going to be buying stuff. You buy it all online, coming through. That's going to be perfect for them. The next stage of this is then, well, how about the investment in the new businesses then coming through and the localization of that? And I think that's going to be actually quite interesting, because you're going to see, and you're already starting to see it, as businesses start to restructure themselves in Britain into various regions, and then provide actually local investment opportunities. And I think that's going to be a fascinating one to follow.
Justin, how can a retail investor put money into that if they believe there's going to be a sort of like a more localization?
Well, that's one of the things that you're looking at. So Dave was talking about small to medium-sized companies, and what we're doing regionally is actually creating the mechanisms that you could actually be able to invest in those local businesses as IPOs or as existing businesses coming through requiring growth investment. And to a great extent, that was cut off for many years. Remember, if you go back to 1945, they weren't very good, but there were technically 45 stock exchanges in this country. Most of them bloody useless, but that's not the point. The plumbing was there to be able to make that sort of investment. We took all that away.
I think, if I could just interject here a moment, I think this is something that Justin and I were discussing before you came. I just think that the next 2 years for the medium-sized stockbroker, British and investment bank, you will never ever get a greater opportunity to make money and to blow away your Deutsche Banks, your UBSs, your Morgan Stanleys. I don't mean the big companies, I'm talking about the medium-sized company. You speak to people at Numis, Pamir Gordon, they are busy. Yeah. And busy. And I'm sure Martin and you, Justin, and you, Chris, will endorse that. They've got things on. Yeah. And this could be a real gangbusters. And this is where AIM, I think, has been, I'm glad we're a competition to AIM, because I think this market, if it's properly run, properly broked, get decent shareholder registered, it's going to help the business.
I guess liquidity is the biggest problem. It is on AIM with a lot of small stocks. But if you can get liquidity, you get it there. Just moving on now to an even more controversial and price to destruction area here. Chris, could you just take... There's a number of very smart investors, fund managers. A guy called Tom Lee from Fundstrap. He's saying to investors, he called the perfect bottom back in March and April, sort of 6 months ago out in the States. He's now saying that essentially we should go into the real, sort of like dark areas of sort of like the airlines, the cruise ships, the restaurants, which are all closed, these sort of stuff. How do you think that's sensible, given effectively the leverage of these areas, even though we might get a positive boost in the economy? What's your view on it?
Well, it's back to what you're saying, isn't it? It's fear and greed. You want to buy stuff where everyone hates it. It's Warren Buffett, isn't it? You've got to be greedy when everyone's fearful. And I mean, the other thing to think of is, there are businesses going bust in some of these areas. I know there's quite a lot of government support, but there is consolidation and supply reduction, which means the winners end up even stronger. So if we get this vaccine, and in fact, I would say the market is talking at the moment about, do we switch from growth into value, or do we barbell it, or when do we start to move? And of course, bond yield is basically the determinant. And so, and if you think about it, we're quite close to the vaccine, probably, and therefore markets anticipate, they're forward-looking. So I think it's time to start averaging across. You're a bold man to do it in one step, I have to say, but I do think over the next few months, if I'm a 6-12-month investor, value will win out, I think. Yeah, absolutely. And Tom Lee will be right on the nose.
Yeah.
Well, one of the worst sectors surely to be in at the moment has to be the airline industry. We know from all sorts of reasons it's going to be doing badly. Does it mean that in 12 months' time, there's no airlines? No, of course not. If we assume there's a vaccine, we're going to be flying again. Those that are stronger will be getting stronger. And it will have got rid of a lot of the wealth. So if you actually think that IAG is, supposedly, despite the fines it seems to be getting for bad database management, leave that on one side, it puts itself in a pretty strong position to actually benefit from this. And the share price is just beautifully reflects that now.
Yeah, there's another stock that's an all-time low, and I cannot believe it that it's so low, is Saga, which is an insurance business, but unfortunately bought 2 cruise ships at the height of the boom. Its shares were trading at about, I think when it was back 10 years ago, about £8, and now they're 20p on the back of it, and it just seems absolutely incredible. But one area that may be a bit safer for investors, rather than sort of like a total moonshot, and I'd be very interested to hear anybody's view on this one, because it's asset-backed, is the UK house builders. I mean, you've got the RIC survey saying that essentially, the sentiment is the highest it's been for 20 years. You've got house prices going through the roof, but you have these really sort of expert economists predicting the house prices are going to decrease by 10, 15% next year. I just can't see it. But has anybody close to this? Why is house trading so low?
I'd say that no, but that's what house builders do. They anticipate, so they always rally when the stimulus goes in. And the worst time to buy them is when everything's at high on all the surveys. So I think housing globally will boom for 2 or 3 years and into 23, 24. So, but I wouldn't buy the home builders because I think they've had their run. It's the same in the States and the UK. You get further upside, but I think they'll underperform once you start seeing bond yields back up. So that's generally the way it works.
Which is interesting you should say that, Chris, because actually the house builders in the UK are trading at sort of 1.2, 1.3 times, book, whereas in the States it's 2 to 3 times book. You've actually seen the run up in house builders in the States, but hey, I think if you spoke to the chairman of Barratt Developments or Taylor Woodrow, they would perhaps disagree that the price has gone moonshotting. Martin, you meant you wanted to have say something? Sorry.
No, I didn't. But I tend to agree. But people are looking to move out of cities into the countryside, I think. But one area of property I think will do well are warehouses or delivery centres. I mean, there's still going to be a massive boom in those because there aren't enough of those yet. And interestingly, it's whether you turn malls into sort of Amazon centres. But I don't know if any of you have ever been in an Amazon delivery centre.
What of robots, isn't it?
Oh my God! I think the thing that shook me was the sheer size. That was what really shook me. I just couldn't believe how big it was. And of course, it's such a fine company, Amazon. I mean, it is the one that's probably the best of the. It completely dominates retailing now.
Is this going to be perhaps the saviour for a lot of out of town retail shop?
Yeah, possibly.
They're going to convert,
possibly, but they're not suitable really, because when you see say for instance the Amazon warehouse just north of Edinburgh, I mean, it is just a massive shed, basically, and it's so big. I just, you can't even begin to, bigger than most shopping.
Can I ask one question, which is basically I take Martin's point, and I 100% endorse it, and I also agree roughly with what Chris said. That it does worry me that the unemployment queue could actually cause a bottleneck, say in 6 months' time, as regards the housing market. What concerns me is commercial property at the moment. I mean, the Great Portland Estates, the British Lands, the Land Securities, the Hammersons, these guys, London Metric, and the rest of it. They're caught between a rock and a hard place, aren't they?
Mm.
Yeah,
Definitely.
I think that's a hard outlook. I think office space and traditional sort of like commercial. What if investors want to have a look at commercial, which is cheap, and also benefit or get exposure to the housing price? Have a look at St Modwen. I mean, talk about localization. That's only a mile down my road. It's is Longbridge, and I can tell you they've already put 3,000 houses, and they've got a site as big as to put 5,000. And and that does exactly what Martin was saying in terms of warehousing and all that sort of stuff. Just as we sort of like come through towards the end of it, the end of this the Capital Markets Summit, any sort of major risks that we should watch? Is it? I mean, I'm with I think the consensus view that we're going to get a vaccine at this point. But if we don't get a vaccine, what does that mean? Would a therapeutic allow us to carry on and exist, and the Nightingales? Can we still bridge the gap until we see the better days? Anybody want to take that one?
Yeah, I think this is what you're going to find is we reach a stage where, and it sounds a bit callous to say so, you learn to live with it, and it carries on, and unfortunately there will be those who will be suffering from it, and it reaches a tolerable level. Now, of course, any death is intolerable to those people involved in it. But if that worst does happen, we don't get a vaccine coming through, that's what does occur. My bigger concern, I think, is some of the geopolitical issues that we've got, that depending on what happens with the American election, but certainly some of the concerns there, we've got some grinding parties against one another in some of the border disputes, which could easily get out of control, very easily indeed. But I tend to put those on one side because you can't measure them.
It's quite interesting that nobody's mentioned Brexit. Does everyone think that's a non-event?
Yeah. Well, it might be over by the end of today.
Yeah.
Well, with Boris walking out.
Exactly. No, I mean, it's not a non-event, but I think the market...
Let Chris...
Go ahead. I was just going to say the market's been thinking about it for 4 years, so... markets get shocked by new things. I think there are much bigger risks as well. I agree with the geopolitics and the lack of a vaccine. There's also a risk, I think, of inflation. I think there's lots of policy that's similar to the lead up to the 70s. So we may well end up with a monetary inflation 1, 2, 3 years out, or indeed potentially currency crises. I think they're much more plausible as you get later into next year and beyond. That would worry me much more.
And what about a political mistake? I mean, Boris. I mean, when you look at it economically, and we're thinking about locking the whole country down again in the UK. I mean, I just cannot get my head around that potential, policy. Even if it's a circuit break, it just doesn't smell right. Particularly when we've got so much capacity and the level of fatalities and hospitalisations are nowhere near which they were back in the spring. I mean. Is there a chance of a political mistake? Could Boris drop the ball on this one?
What, again? I mean, yeah, it is not being well handled. Mind you, I would say
very badly handled.
But I wouldn't have an easy answer myself. But I don't think anyone can afford to go for another full lockdown again. No, we've been through that process. It wasn't necessarily going to give us a complete result. We're going to have to try and work our way through this in a more painful way. But at the moment, we've actually got the position where the northern half of England's almost deciding to feel it's being treated badly. But don't worry, it's being being looked after by the Foreign Secretary. Doesn't really make sense too much.
No, I think at the end of the day, that surely this has to be right. Look at the data. Now, there are two people involved in this conversation, of which I am at the top of the list. that has to take care of themselves. I've had a bloody good life, and I'm really grateful for it. And I insist on anybody aged 50 and younger has the chance to express themselves. So people like me, get out of the way, don't be a nuisance and get yourselves lumbered in hospital and then die with a terrible death. Behave yourself, because the deaths from COVID with people without underlying health issues are negligible. And as Justin said, any death is horrible, but put the thing in perspective.
And have you got any final words at all, Martin, in terms of where you're putting your money at the moment and the outlook?
No, I've always liked Asia, ASEAN. I've always liked it. I think it's a great opportunity for us as stock pickers. I really do. I think there's so much opportunity and value out there in the markets, and I agree with David. I saw a statistic that more people drown than die of COVID under 50. So I think it's I agree 100%. We've got to get on and learn how to live with this. But I think the politicians are so terrified of seeing hospital beds full, these sort of things. But it seemed odd to me to lock down a whole economy. Really, the way we've done it.
Yeah, and then Chris, they're just on the final sort of like positive view going forward. Anything else to add? I mean, obviously, I'm very much hoping you're right.
Well, absolutely. I think it's fascinating times because the growth cycle is very mature. Been going on for several years now, and I love the history of stock markets because every sort of bull market has a different flavour. And I think if I was a 5-year betting man, you've got to bet on value. There's no two ways about it. And I would agree. We'll learn to live with this disease. Other gentlemen in this panel may well remember the '69 Hong Kong flu. That was the year I was born, so I don't remember any of it. But of course, nothing really happened as far as I'm aware. Life carried on and people got used to it. So, human beings are remarkably adaptable. I'm very good at adapting to these things, and what is it? 25% of hospitalizations are now go onto ventilators instead of 75% in March. We're already learning, so I'm very optimistic.
All right, well, thanks very much, guys. I think we've hit the sort of 50-minute button, so I really appreciate your views and your insights, and look forward to repeating it in 3 months' time. So thanks, guys.
Take care.
Thank you very much indeed.
Thank
Enjoyed
you.
it enormously.
Thanks a lot.
Thank you.
See you guys.